Welcome to this explainer. Today, we're pulling back the curtain on the absolute giant of the financial world, the global Forex market. We're going to break down the complex mechanics of how currencies are exchanged on an institutional scale and figure out what's really driving the numbers ticking across those financial news screens you see every day. Let's dive right in. $6 trillion every single day. Just to put the sheer scale of that liquidity into perspective for a second, that completely dwarfs the global equities and bond markets combined. It's massive. And we aren't just talking about regular folks swapping cash at the airport for a vacation, right? This staggering volume is driven by multinational corporations hedging global payrolls and supply chain costs, central banks actively managing their nation's foreign reserves, and massive quantitative hedge funds executing high-frequency algorithmic trades. It's literally an ocean of institutional liquidity, constantly moving, shifting, and generating opportunities at a true macroeconomic scale. So here's our roadmap for today's explainer. First, we'll look at the $6 trillion market itself. Then, what actually drives currency values? Third, the mechanics of Forex trading. Fourth, we'll check out the top Forex trading platforms. And finally, managing risks in Forex. All right, let's jump straight into part one, the $6 trillion market, understanding the scale. So this market operates as an incredibly liquid financial engine that runs 24 hours a day, 5 days a week. It simply never sleeps during the work week. Capital just flows seamlessly as major financial hubs overlap, from Tokyo over to London and finally landing in New York. But at the very core of this endless global exchange is one fundamental action: buying one currency while simultaneously selling another to capitalize on fluctuating exchange rates. Think of it kind of like a giant economic tug-of-war. Currencies are never traded in isolation. They're always traded in pairs. You're essentially pitting two distinct national economies right against each other. When you execute a trade, you're placing a bet on relative economic strength, shifting monetary policy and international capital flows. You're basically predicting that one side of the pair is going to appreciate while the other side depreciates. Now, while there are countless national currencies around the globe, the vast majority of that $6 trillion daily volume, it's concentrated in four undisputed heavyweights: the US dollar, the euro, the Japanese yen, and the British pound. The US dollar alone is involved in nearly 90% of all Forex transactions. 90%. That completely cements its status as the world's primary reserve currency and the baseline for pricing global commodities. Then you have the euro, representing the collective economic weight of a massive, unified European trading bloc. The Japanese yen, on the other hand, acts as a traditional safe haven asset, and it's a primary vehicle for complex carry trades because of its historically low interest rates. And finally, the British pound maintains its heavy influence thanks to London's enduring position as a premier global financial hub. Basically, these are the major players providing all that massive continuous liquidity. Okay, moving on to part two. What drives currency values? The invisible hands. To really understand what actually moves the needle on these currency valuations, we have to look at the interconnected macroeconomic forces at play. It's basically a giant domino effect. First up, you have core economic indicators, things like a country's GDP growth or the consumer price index measuring inflation. These dictate the underlying health of an economy. Now, when inflation runs hot, it forces central banks to step in and adjust interest rates. And man, these monetary policy decisions are the heavy drivers of the market. A surprise rate hike, that generally attracts a ton of foreign investment seeking higher yields, which instantly drives up the value of that currency. But as we know, these calculated economic models are frequently disrupted by human events. Sudden geopolitical conflicts, political instability, or shifting international trade agreements can literally reroute global capital overnight. Ultimately, all these factors coalesce to drive overall market sentiment, constantly shifting investor psychology between risk appetite and risk aversion. Which brings us to part three, mechanics of Forex trading, how trades execute. So understanding those macroeconomic forces is one thing, but how do traders actually maneuver to capitalize on them in a continuous, fast-paced market? Well, the global exchange operates through a few distinct mechanisms. On one side, you have the spot market. This facilitates the immediate, real-time exchange of currencies at the exact current market rate. This instant settlement is heavily favored by day traders and algorithmic systems trying to capitalize on that minute-by-minute volatility. But on the flip side, you have forward and futures contracts. This is the realm of strategic forward planning. These contracts allow participants to lock in a specific exchange rate today for a set date in the future. They're absolutely essential tools, used heavily by multinational companies to hedge against long-term currency risk for their future international purchases. Let's look at part four, top Forex trading platforms, your access point. So, you might be wondering, how does a retail trader sitting at home actually tap into this trillion-dollar institutional pipeline? Well, the primary gateway is a trading platform, and selecting the right broker is a pretty critical strategic choice depending on your specific trading style. For example, if extreme accessibility is your top priority, platforms like XNES offer incredibly low barriers to entry. We're talking minimum deposits as low as $1 alongside unlimited maximum leverage and tight spreads. But if you're prioritizing foundational knowledge over, say, extreme leverage, a broker like AvaTrade provides a structured, university-style curriculum with over 150 lessons to help build actual competence. Now, for the algorithmic traders or scalpers out there who rely on micro-movements, an ECN environment with ultra-fast execution like IC markets is absolutely non-negotiable. And for those requiring deep technical analysis, FX Pro provides a really comprehensive suite of advanced trading tools. It really just depends on what you need to succeed. Finally, Part 5. Managing Risks in Forex, the Reality Check. We've spent a lot of time discussing the immense scale and the liquid nature of this market, but alongside that vast opportunity comes some very significant inherent risk. The everyday reality of institutional currency exchange is severe volatility. Unforeseen global crises, sudden political instability, surprising macroeconomic data drops, all of these can trigger wild, unpredictable price fluctuations in just a matter of seconds. And when you combine that extreme volatility with the high leverage offered by modern retail platforms, the danger multiplies exponentially. Look, leverage is the ultimate double-edged sword. A highly leveraged account can be entirely wiped out by a single unexpected rate hike if your risk management isn't mathematically calculated beforehand. Navigating this environment demands rigid discipline, strict leverage control, and the absolute necessity of utilizing automated stop-loss orders to protect your capital before severe drawdowns even happen. Which leaves us with this final thought. In a market driven by global chaos, is your risk management strong enough to survive the storm? It's a pretty sobering yet vital challenge to end on. Operating in the world's largest and most volatile financial marketplace isn't just about understanding macroeconomics or predicting trends. It's about having the unshakable discipline to protect your capital when the unexpected inevitably happens. Take some time to contemplate your own strategies and discipline. Thanks so much for joining me for this explainer, and I'll catch you next time.